What up, guys? It's January 31st, and today we mean business, right? We got my Wall Street logo, Wall Street Rooster logo hat today, so you know I'm focused and I'm ready to talk earnings with you all. And we're going to talk about NXP Semiconductor, who reported yesterday after the bell and held their conference call this morning. So we're processing all the data, all the information, all the numbers, conference call details, and I'm going to break it down for you on this video, okay? If you're interested, please leave me a like and subscribe. Definitely appreciate your help, and hopefully you learn something from these videos. And I got to say, earnings videos are my favorite because I feel like you get the most out of them, and you really get to know a company inside out when you really do a dive into their earnings, right? Let's get to it. So here we go. If you guys have heard me before, if you've watched my prior videos, and I'll probably try to link my videos here while I'm doing this. NXP is a company that I've talked about several times. If you can, listen to my video on CES when I do the CES reaction. Again, very angry that NXP doesn't let you into the CES booth, the one that's outside the convention center on the parking lot. That's like the 2-story booth. That's huge. They don't let anybody who doesn't have an invitation in there. I have a huge problem with that as a shareholder, but hopefully next year it's a little bit different, all right? So just as a quick reminder to you guys that don't know NXP, so you don't have to go back and reference the other videos, we hold NXP for its automotive exposure, okay? Automotive, it's 52%, greater than half of the business. After that, our second interest is industrial and IoT, representing 21% of the business, and then mobile and telecommunication, communication infrastructure, telecom makes up the rest here, and that's not the most interest part of the business, but it's a little bit of a sort of diversification play for NXP. If you guys have any questions about the business or think that, like I said, reference my prior videos. Also here, the official site on NXP. If you go to nxp.com, you'll see here virtual demo and product experience, the tour the technology showroom, okay? This is what they told me to go see at CES. They said, hey, go online and check this out because we're not going to let you in, but that's the next best thing. And if you see here, it's a really nice digital showroom where you can see all kinds of aspects. We're looking at the digital home. We're looking at AI and machine learning solutions and kind of what they're looking at and what their value proposition are for those segments. So again, if you guys want to get familiar with NXP, you got to get to the showroom and look around and see what you find. And I think it'll surprise you. But now to the real stuff, we'll move on to my position in NXP Semi, and I'll show you guys here. So you guys know I have skin in the game. This is not a whatever position for me. This represents like 10% of my portfolio is NXP Semiconductors. We see here I got 55 shares at 176.94 per share. Current price 184.31. We're up 4% on the position for a total $405 a share, and in my opinion, it's going to go higher. It's going to go above that $200 mark and keep going higher. It's a great stock with a great valuation, great future. That automotive is just going to get better and better, which will make the stock go higher, in my humble opinion. Now let's move on to the earnings numbers. Okay, so we got here NXP with a double beat on top and bottom line and a slight revenue miss, and we'll talk a little bit about that in a second, but we'll start with, of course, the metrics here. Market cap, $46.5 billion company. It's a mid-size cap stock. PE, according to Seeking Alpha, the PE metrics, price to earnings metrics, 12.91 on the current PE and forward PE of 12.54. Very cheap, especially against its peers on the other semiconductor names. Cheap against those. Dividend yield 1.88%. Remember, the stock goes higher, it yields less. As the stock goes lower, it yields more. And then the payout ratio is 22.28%. Why do you see a payout ratio? That marks this how safe the dividend is, right? We want to see stocks with a payout ratio of less than 50%. If we see stocks above 50%, it means that dividend is not as safe as as it needs to be. Anything under 25 is a very safe dividend, in my opinion. So very good marks here for NXP Semi on the valuation front and dividend front. So we'll start with EPS. That's earnings per share, 276 versus 275. It's a slight beat, okay, but it's a good beat overall. Revenue, 3.31 versus 3.21. That's a solid beat. And the guidance, a little bit lighter. That's why I call it a slight miss. A little bit lighter than expectations. So the range given for next quarter, $2.9 to $3.1 billion. The street was expecting 3.18, so about an $80 million difference there as far as, and forgive my writing here, $80 million difference as far as quarterly guidance. EPS guidance 2.82 to 3.22. That makes 3.02 the midpoint of that range. The street was expecting something closer to 315. And a little bit weird here how they're doing that, because I feel like they're expanding these ranges a little bit more than they need to, right? They're making them a little bit longer. I would have liked to see a 5 here to kind of offset this one, which is quite low. I think they're really sandbagging here a little bit on this guidance and setting a little bit of a sandbag number on the mid-range, making it easy to beat, and I think they will beat that, but the street was expecting 3.15. Again, the top expectation is 3.22. I think they can get close to that based on what I'm about to tell you moving forward. So let's move forward. Now let's take a look at the chart. After they reported earnings, or these numbers, you'll see here, and it was a little bit hard to see because I was, of course, paying attention to the chart as soon as these earnings hit. And the earnings hit right here at this time on the 31st when the market closed. But this doesn't tell the whole story, because the stock went down to 172 in that after hours market between, whatever this is, 5 p.m. to 9 a.m. the next morning. There's a little bit of missing data here, and I tried to find it in a couple of charts. I couldn't find it, but the stock did go down in the aftermarket to 172. I think it was 172.30, if I'm not mistaken. And I lost my mind. I thought, what are these guys looking at? And of course, it prompted me to go on Twitter and get nice with people, right? And right here, hey guys, hey nice people selling NXPI. This is a hugely profitable, growing revenues at 20% year over year, profitable with huge free cash flow streams, trading at 11 times forward earnings back then, 11 times, now 12 because the stock went higher, and just increased their dividend by 20%. What is your issue, sellers? And of course, sellers were wrong. If we look at the share price right now, like we just did, 184 is the share price, not 172. It's a 12-point swing, right, from this stock. So amazing performance after people actually heard the call and realized what they had on hand. Now let's move on, quickly look at some charts here by end segment market here, and we'll start here with automotive. And it's a little bit confusing because it's very small differential here as far, and I'll put it here in the green, as far as these numbers here. These go higher, as you can see, 17% year over year for automotive, but every number just, slightly better for automotive. And it's an improving thing. Right now, these markets are not supposed to be, or these companies are not supposed to be blowing it out of the water. These guys have inventory issues, excess inventory, and all this pull forward demand that no longer is there, especially on mobile infrastructure. You guys will see that in a minute. So on industrial, it's a little bit of the same until Q3, and then drops off on Q4 2022. Here you can see 713 versus 605. Mobile, that's your telecommunication stuff. Or actually, no, not telecommunication, mobile cell phones. You see here 410, 48. Pretty steady stuff here. Nice increase here, right? But decrease here. And then telecom, pretty much the same story here on a quarterly revenue basis when we're looking at quarter over quarter. Okay, hopefully that makes sense. Now that last chart could be a little confusing, and I did that on purpose so you can see the yearly, annual revenues and how they compare. Now we were looking at quarter over quarter. Now we're looking at year over year, and you can see here same thing: 19, 20, 21, and 22. Automotive is very, very strong, guys. We heard this from Texas Instruments. We heard this from other chip manufacturers. Automotive is the big dog, strong dog at the moment for these chip stocks, okay? Then we have industrial IoT, slightly stronger. Mobile, a little bit strong. And then telecom is sort of like the flat performer on the yearly basis. So hopefully this clears up a little bit about their performance and how automotive is really driving the stock higher. Now, here's another chart that kind of puts things into perspective. We're looking at growth rates, right? And we're looking at margins. So you see here growth rates and margins, steady growth rate. And look at the word CAGR. That's a compounding annual growth rate. That's what that stands for. And then we got gross margins, we got operating margins, and free cash flow margin. So these go hand in hand on a company's income statement, or when you're reading their income statement. First, you get the gross margin, right, which is essentially the revenues minus the costs of doing business, right? What's called a COG, right? Cost of business, or whatever it stands for. But what does it stand for here? That's cost of goods sold, right? COGS, cost of goods sold. So essentially, again, revenues minus costs of goods sold gives you your gross margin. And then when we move on to that, the gross margin, you take the operating margin, and that is the cost of goods sold minus their operating expenses. And then here, the difference is the free cash flow. So you can see here how essentially that, or the flow of this is like this. That's the flow of this chart. And you can see pretty strong improving margins on a yearly basis. So nothing wrong with their margins as far as NXP on a yearly basis. Now let's move on and not talk about margin stuff that always confuses people and it's hard to explain. But we're going to talk about the highlights of the call, okay? And the highlights are pretty simple this time around, guys. So mobile industrial doing a lot better than expected. And I was kind of like, really? Is that the case? Yeah, better than expected, right? Better performance, better management, better execution, driving those to not as bad as expected levels. Again, the IoT and sort of like the mobile telecom, the street was expecting bad from that, but we didn't get the bad that the street expected. That's why the stock is moving higher. Automotive is strong, we know that. Telecom below expectation. That's the bad, sort of flattish performer of the group. And then year over year, quarterly revenue growth, amazing. 19% full year over year revenue growth, impressive. And then channel inventory. That's something that's very important that you hear in a conference call. And a lot of questions from the street analysts, like the Bank of America, the Deutsche Bank people asking about channel inventory. Everybody knows, or everybody who follows the chip sector knows, that they have an inventory issue. Before, in 2020, 2021, when all these electronics were being sold, when people were working from home, there was a lot of pull forward of years worth of demand, right? People who got computers, phones, laptops, iPads, cars, whatever you call it, they pulled forward a lot of years worth of demand in the future. Now there's a semiconductor glut. Too many chips in the system out there, but NXP is doing a good job at keeping 1.6 months worth of supply when their long-term target is really 2.6. So they're 1 month below their inventory target, depending on what China is doing. So when China reopens, they could increase the inventory to fulfill that China demand. But what's going on with China? They've been in lockdown. They're just recently now opening. So that's going to be the difference between 1.6 months of supply versus 2.5 months of supply. Okay, now they're citing demand is robust across automotive and industrial markets, but the demand still outstrips the supply, even as they improve their production levels. That's good to hear that they can't satisfy demand, but they're improving production levels to satisfy this demand. It would be a problem if they didn't have the demand and they were oversupplying the lack of demand. That would be a problem. Not the case here. Inflation still a factor, but it's not at the same pace as the rest of 2022. That's good to hear that they're sort of getting over that hump of inflation and price hikes of their products. And then automotive, of course, 25% for the full year, 17% versus the same quarter last year, thanks to secular growth trends, price increases, and content increases. The key word here is content increases, guys. Content increases is, like we've talked about, and I've talked about this in many videos, a gas internal combustion engine vehicle, what you call an ICE vehicle, has way less chips than an electric vehicle. You're talking about like 3,000 chips in an electric vehicle versus a couple hundred on an ICE vehicle. That's what content increases are, guys. So very good there for NXP, citing that secular growth trend. Again, opposite of cyclical. Cyclical meaning it's a cycle, it's an economic cycle that follows. Secular means it does well no matter what the economic cycle looks like. Whether it's a recession, whether it's a bull market, whatever it is, it doesn't matter. It's still a secular growth trend, okay? Hopefully I explained that well. Industrial and IoT segments, 13% full year, down 8% versus the same quarter, but better than the guidance. This is where it starts getting a little bit confusing because it's like they were good, but not as good as before, but above what we thought they would be. That's essentially what it is. And then same numbers, pretty close here for mobile and telecom. Very important now, we're talking about the dividend, a 20% dividend hike or a little bit over $1 per share. Now we're getting about $1 per share every quarter for our dividend, which is amazing. So every time I have 55 shares of NXP at the moment, every quarter I'm getting a little bit over $55, maybe 56, 57 bucks that I'm getting, and I'll be very happy with that dividend and reinvest those proceeds back into NXP or another stock of my choosing every quarter, and it compounds with other dividend makers in my portfolio. So very happy to see that. So that's going to be it for today, guys. Very good quarter by NXP. Much better than expected. It's been called the nicest house in a bad neighborhood for the chips, right? This is not Intel. This is not the disaster that Intel was. It was a strong quarter guided by automotive, by industrial, and I think it's going to get better and better. The valuation is fair, and if the stock ever falls under 170 again, I definitely will consider adding strongly to this position. If you have anything under 170, good for you, okay? Because you have a pretty good price to earnings ratio that you bought that in, and you can compound that growth over the years with your dividend and the share appreciation, okay? If you guys have any questions about NXP or anything that I talked about in this video, please let me know. Drop a comment below. Hit me up on Instagram for all stock market news and on Twitter for a bunch of crazy nonsense that happens there. Peace out.